for 12,000 naira, 100 naira per product. The products are transferred to the customer over a 6-month period. The entity transfers control of each product at a point in time. After the entity has transferred control of 60 products to the customer, the contract is modified to require the delivery of an additional 30 products, a total of 150 identical products to the customer. When the contract is modified, the price of the contract modification for the additional 30 products is an additional 2,850 naira or 95 naira per product. The pricing for the additional products reflects the standalone selling price of the product at the time of the contract modification, and the additional products are distinct from the original product. Does this contract modification constitute a separate contract?
Okay, so you bought, in fact, you sold 120 products to a customer at 100 naira each, Abi? So when you delivered 60 out of it, the customer now came and said that he wants to buy additional 30. So in the question, they told us that that additional 30 is distinct. Abi? They told us clearly in the question that that additional 30 is what? Is distinct. So I intentionally, because I've not told you what distinct means, I put it there. But even if they put it there, some people might not know. That's if you don't know. That's one. Number two is that how much are they charging for the additional 30? 95 naira for each one. Okay. But ordinarily in the original contract, it was how much? 100 naira. Okay, so can that 95 be a standalone selling price? Okay, yeah. In fact, it was mentioned in the question. Abi? The question said that that 95 naira is a standalone selling price. What if the question did not state it? Can we assume that's a standalone? You know that standalone selling price is how much you will have sold the goods ordinarily. That this is how much you sell. So if you sold it 100 naira earlier, you're now selling it 95 naira. Is that a standalone? It's the same now. The guy said he wants additional 30. Fantastic. Yeah. Fantastic. That's a very logical answer. That because probably he's buying extra. That was why they reduced the price for him from that's correct. So it's a standalone selling price. It's a standalone selling price. Yes. To answer this question, it's just for you to tell them that a contract modification is a separate contract if the scope of the contract increases because of addition of promised goods or services that are distinct. If the price of the contract increases by an amount that reflects standalone selling price of the goods or services too. From the question, it's clear that the addition of the goods or services is what? Distinct. The changes in price is a what? Standalone selling prices. That's it. That's it. So we're going to treat that change, that addition of goods and changes in price as a what? Separate contract. Which of them? What does it mean? I will get there. That's why I said just see distinct. At least in this question, they said distinct. Abi? So it's intentional because I'm teaching you step by step. So I will get there in few minutes. In few minutes. Okay. So now, what I wanted to ask before I forgot was that what if what if the change in price is not a standalone selling price? That means that that modification would not be a what? It won't be a separate contract. That means that these two must be present. The change in scope must be an addition of goods that is distinct. The change in price must be a standalone selling price. So what will now happen? Yes. What will happen? You know that we are saying this addition is not a separate contract. So that means we would, yeah. But the term I want you to use is that first, you will terminate the original, it will result in termination of the original contract and the creation of a new one. So it will be termination of the original one. That means the contract won't be 120 product anymore. It's now 150. Okay, I just want to prepare your mind because I kind of asked you before that what forms can contract modification take? So number one, contract modification can result in creation of a new contract, the termination of an existing contract, and having a separate what? Separate contract. So the one that the standard really is really bothered about is where a contract modification can result in a what? Separate contract. Which are these two criteria? If they, for whatever reason, they do not meet these two criteria, that means we're going to treat it as what? Termination of the original and creation of a what? A new contract. Any other question there? Okay. Not distinct too. I will explain that very soon. Okay.
So the second part where they said, I want to understand how exactly you knew that it is standalone price.
Because they told us in the question.
Aside, you said if they did not say it, how do we
The
know
price should be very close.
close to the initial price?
Yes.
Okay. So
The price per product must be very close.
So if they give us 15 naira, we
Mm,
don't have a standalone.
exactly.
Okay. So is there a limit for this? Like
There's not
80%
really a
or
particular limit. It's a judgment thing. So in the exam, they will make it so close that you would know that this one,
if they make it so low, then
yes, is not. Brother?
I wanted to ask that in this kind of situation that we have two prices and there is need to cancel the first contract and establish the new contract. Which price are we now going to use?
Old price for the remaining products of the old one, new price for the new one. Yeah. So, and you can get an, but that is just the easiest. That's just the easiest. Okay, step two. Now, these things you see now. Step two. Okay, now the step two is to identify separate performance obligation. Identify separate performance obligation. Now, the first one is that there has to be a contract. And you all agree with me that every contract would contain a promise to transfer goods or services. Now, that promise to transfer goods or services is what we mean by performance obligation. That goods or services you want to transfer is the what? Performance obligation. The core, what step two wants to look at is your ability to identify separate performance obligation. Because in a contract, there could be more than one goods or services. Like the example I gave him, you are an influencer. Maybe in a single contract, you want to do video creation, you want to do posting, you want to do user interaction. So are you going to see, are each of them separate performance obligation or single? So now, it's important we're able to identify separate performance obligation. Then the key thing is this: which performance obligation is separate, or which goods or services is separate? Is a good or services that is distinct. So now we're back to distinct. So for you to identify good or service that is separate, is anyone that is distinct. Then what is distinct? So A goods or services is distinct. A performance obligation, or when I say performance obligation, I mean the promised goods or services, is distinct if it can be sold, separately, because because it has distinct function and a distinct profit margin. That's distinct. A performance obligation is distinct if it can be sold separately. Sold separately because it has distinct function and a distinct what? Then two things here. Distinct function and what? Distinct profit margin. So when I say distinct function, it means the function of that goods is such that the customer can benefit from that goods on its own. On its own. It's just like a diet before now. We used to give out free packs. When Tinubu came, we stopped because we know we'll be running at a loss if we try that. So now, then, when we want to recognize our revenue now, the tutorial service and the books, can we treat, even though we're not charging for the books, can we treat them as a single performance obligation or distinct or separate performance obligation? The answer is that they are distinct. Because the tutorial service, you can enjoy that service on its own. And that has been confirmed now, except for those that still need compulsorily the hard copy and they were ready to pay for it. So the tutorial service itself is distinct because you can benefit from it on its own. The books is distinct. It has a distinct function. We have students that come, walk in, buy, and go because they want to go and read on their own, and they pass. So the books also has a what? A distinct function. So when such happens, Yeah.
Ricky Limited, a contractor, enters a contract to build a hospital for a customer. Ricky Limited is responsible for the overall management of the project and identifies various goods and services to be provided, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of equipment, and finishing. Ricky Limited and its competitors regularly sells many of these goods and services separately to other customers. Explain whether the promised goods and services can be treated as a separate performance obligation.
Now, you're asking if those goods or services can be treated as a separate performance obligation. And the question is, which goods or services are they talking about? So I can see here that what Ricky wants to do is to build an hospital. Abi? And the function or performance obligations we can see here: engineering, site clearing, foundation, construction of the culture, piping, and whatever. Each of them are performance obligation, but are each of them distinct? I mean, in asking, do they have a distinct function? Can the customer benefit from each of those performance obligation on their own? Who? Okay, so okay, good. They can say the same, but can the customer benefit from each of them separately? Because what he needs is an hospital, right? So that means it doesn't have a distinct function. Now, are each of them separately identifiable? Meaning that are they integrated with one another? Are they integrated? Are they interrelated with one another? And you know what I mean by integrated is that is it an input to another whereby the one have it? So they are not distinct. They are not distinct. For it to be distinct, it must have a distinct function, meaning the customer can benefit from it on his own. Number two is that it must be separately identifiable. It must not be an input to another level. He must not wait for another level before he can do his own. No, he must be able to be sold separately. Yes, it must be standalone. It must be separately what? Identifiable in such a way that we can know how much profit we have made from it. On that basis, all of them, we are going to see them as a single performance obligation. They are not separate. They are all what? Single performance obligation. Second question.
Kako Limited, a startup tech company, develops an app for use by businesses. It enters into a contract with a customer to supply the following: license to use the app, installation service. This may require an upgrade to the computer operating system, technical support for 4 years, 3 years of update. The installation service can be performed by Kako Limited competitors and it does not modify the app. The app can remain functional without the updates and technical support. Explain whether the promised goods and services can be treated as a separate performance obligation.
So can they be treated as a separate performance obligation? Okay, let's look at it. So the performance obligation here is license to use an app, installation, there's technical support, and there's updates. Abi, we're told that competitors can provide the installation, right? We're told that the app can remain functional without the update and technical support. So that means Kako can just easily sell the license and we expect the customer to be able to benefit from it on his own. So the license itself is distinct, right? The installation, that means the customer can get another person to do the installation because the app is even functional, but you need somebody to, of course, install it. So the installation itself is also a distinct performance obligation. The app even functions without update and technical support. So that means the technical support is distinct, is separate. The updates is distinct, is separate. So each of them are separate performance obligation. They have a distinct function and a distinct profit margin. Step 2 ended. Step 3. So now, step 3 is the transaction price. Is to determine the what? Transaction price. This one is always straightforward because it's always stated. So there is no effort here because the transaction price is the consideration an entity is entitled to in exchange for the transfer of promised goods or what? Of promised goods or services. That is a transaction price. Oh, the transaction price is the consideration. So the last time they asked you about transaction price is that define or explain the difference between transaction price and standalone selling price. That's explain transaction price and what? Standalone selling price. So this transaction price is the price or the consideration an entity is entitled to in exchange for the transfer of promised goods or what? Or services. That's the transaction price on that contract. But standalone selling price is the amount you will have sold a good or services on its own, separately. That's standalone selling price. So for step 3 is just for you to be able to know what is the transaction price. How much consideration are we entitled what? Are we entitled to? So the thing is just that you have to be very careful when it comes to transaction price because some transaction price might be variable. They might be what? And usually is when there is a discount involved. Right? When there's a discount involved, like a volume discount, you need to be careful not to include that. If you have said that, I will reduce your price. So don't include that. If it's a discount that you are giving almost immediately. So it could happen that transaction price could be variable. And also, transaction price can also be affected by time value of money. Yes, because if you give somebody credit for so long, like 6 months, you need to consider time value of money. In fact, the standard says that in addition to that price, you need to also recognize an interest income because you are going to treat it as if you have given a loan to that person. You need to recognize a what? An interest income. But the good thing about, they have never asked something like that at your level, but it's always very clear. They will tell you that, okay, if this guy was supposed to pay immediately, he will have paid 10 naira. But for the fact that we are allowing him to pay over 6 months, he's going to pay 11 naira. So that means that extra 1 naira is what? Is interest income. That extra 1 naira is interest income. So the point here is that the transaction price might be affected by time value of money. And there could even be non-cash consideration. There are consideration that could be non-cash, that they might be payable in another way. It's possible. So we need to find a way to get, okay, what's the value of that? And we're going to use that to determine our transaction price. And there are even some instances where you have promised the customer that if you buy something from me, I will give you one wine, I will give you car, I will give you ram, I will give you 2 bags of oil. You know, if such are involved that you are giving back to the customer, you need to also deduct that from your what? Your consideration, because it has reduced your consideration you are what? You are entitled to. So all of that. But the core thing for you is transaction price is this definition of transaction price. That's step 3. Discounts. Discounts. If I'm going to give you a discount if you buy plenty, okay? What? So let's go to step 4. Step 4. Now, okay, please look at this. Step 3 is not a problem for us, but step 4, that one will require some energy. So step 4 is saying that allocate the transaction price to the separate performance obligation. And this is happening, or this will occur. Step 4 will be relevant in cases where you have more than one separate performance obligation, where there are more than one goods or services you have to deliver, different goods or services that are distinct. So if the contract is structured in such a way that you know the transaction price for each of them, that one is not a problem, because they have already given us the prices of each separate performance obligation. But if it happens that we have separate performance obligation, then now you're not agreed one price. You have to allocate it. You have to allocate the performance obligation on the basis of their standalone selling prices. So that means they will have, yes. So you have to allocate on the basis of their standalone. It's just like the school I said last night now. We'll say lecture fees and books. The way we're doing it is that we just say the lecture fee for 2 papers is 60,000, right? A single transaction price, and there are 2 performance obligation, the tutorial service and the books. So we need to get what's the standalone selling price of each of them. So it is on that basis we are going to allocate the what? The transaction price. It's on that basis we are going to allocate the transaction price. Thank you. Okay. Now, we have to look at the question to properly explain that. Yeah. Let's do the question.
A network service company gives customers a free handset when they sign a 2-year contract for provision of network services. The handset has a stand-alone price of 200 naira and the contract is for 40 naira per month. How should revenue be recognized?
Okay. So a network service like Glo, MTN, and all of that. These guys are so nice. They give you free handset, and you're supposed to key into a contract like a network service where you pay 40 naira per month. Okay. So to them now, if I may ask you, what's the transaction price? 100 barrel. What transaction price? What transaction price is how much is the network service going to collect? The consideration they will get over the 2 years. Two which one is 200 naira? Are they collecting it? Didn't they give them free? Uh-huh. The transaction price is 14 naira times what? 24. So the key thing here is this. There are two separate performance obligations here. The network service and the handset. Because the handset has a distinct function and a distinct profit margin. So, but these guys, they are not charging for it. But you as the accountant, we account for distinct performance obligation. So when we have situation like that, if there are more than one distinct performance obligation, we have to allocate the transaction price to all of them. Even though they are not collecting money for it, we allocate transaction price to it. That's what step 4 wants to do. So how do we do the allocation? We say it will be on the basis of their standalone selling prices. So let's get the basis of how we want to allocate first. When we get the basis of that allocation, then we then allocate on that basis. So let's get the basis of allocation. For the handset, what's the standalone selling price of the handset? For the network service, 40 naira times what? How much is that? So what's the total? So let's now do a proportionate allocation. What's 200 over 160 times 100? 17%. What about this one? 83. So this is the basis on which we are going to allocate. So now let's allocate the transaction price. So how much is the transaction price? 900 and the transaction is not 1160. Oh. The transaction is what we are going to collect is 960. That's the transaction price. We are not collecting money from the handset. It's free. So we're only collecting 960. So it is this 960 we want to share between the handsets and the network. This one I did there is just to get the basis of sharing based on their standalone selling prices. So in year 1, because there are 2 years now, in accounting we recognize yearly. Abi? So in year 1, the handset will get how many percent of the 960? And how much is that? The network service will get how many percent? But since it's 2 years, we'll recognize it equally over the 2 years. We'll recognize it equally over the what? 2 years. So how much is year 1 getting? So what's the addition? In year 2, sorry? Put the correct figure in your note now. That is the principle I'm concerned about at this point. So this is how you allocate the transaction price. Okay? So you will see that even though the handset was given for free, but for the fact that is a standalone, is a separate performance obligation, we will still have to allocate some portion of the transaction price to it. And this is the basis of the allocation, based on their standalone selling prices. So they already told us in the question that the standalone selling price of the handset is 200. That if we were to sell the handset, we will have sold it for how much? 200. And the network is clear, is 960. So we now got like a percentage for sharing. 200 over 1160, 960 over 1160. Now, we now need to allocate the transaction price of how much? Because that's how much the network service will collect. Just 960, 14 naira per month. So for the handset in year one, he's only going to get 17% of that 960. 17% of that 960. The network will be 83% of that 960. But since it's over 2 years, so that's why I splitted it over 2 years. So year one got 399, year two got how much? 399. It won't be more than this. That is how you allocate transaction price to separate performance what? This is the order. You get the basis of allocation, then you allocate. Yeah. What's the time? Year one, yes. And this is year two. Okay, we're almost there. We are in the final step. We are in the final step. We are almost there. In 15 minutes, this class should be over. Then you can go on your break and enjoy the life of your head. Okay? Can I go on? So step 5, that says that recognize revenue when performance obligation is satisfied. So meaning when you have transferred control to the customer, when you have transferred the goods to the customer, then you can then recognize what? Revenue. You can recognize revenue. Now, in recognizing revenue when performance obligation is satisfied, you need to consider the two ways in which you can satisfy this obligation. Because there are certain obligations that are satisfied over time, and there are some that are satisfied at a point in time. Yes, immediately. So the way we recognize revenue in the two are different. They are not the same. So if it is satisfied over time, if it is what? If it is satisfied over time, like what is happening at equity, the performance obligation is satisfied what? Over time. Then we need to ask ourselves, if you want to be recognizing revenue every month or every quarter, it now depends on you. Then the key question is, can you measure the outcome of your performance? Can you measure the outcome? In the sense that if at the end of the month, can you say, I have done, okay, can you say at the end of the month, I have done 20%? Or at the end of at the end of 2 months, I have done 50%? I've done 70%. If you can say that, then it's straightforward. That means you can measure each outcome. You can measure its outcome. So if you can measure its outcome, then it's easy to recognize revenue. That means at the end of each month, you say, okay, I've done 20%. Then it's just 20% of the total money I'm expecting. 20% of the total money I'm expecting. Abi, you recognize that as revenue. In the other month too, how long have I gone? So When performance obligation is satisfied over time, you recognize revenue based on the work done, based on performance completed. Abi? That's one. But what if you cannot measure the outcome? That you cannot attribute a measurement basis to what you have done. Then how do you recognize revenue? What do you do? By time. Okay, I think a better way that the standard recommended is using the cost you have incurred to date. If you are sure that you recover that cost. So you recognize revenue based on the cost you have incurred to what? To date. And that is how you recognize revenue when performance obligation is satisfied over time.
In the sense that you might have even incurred more money at the beginning than in the long run, of which you have not improved what you have spent.
Everything will balance out eventually. Yeah. I mean, that is how it is. So if you can measure the outcome, that one is easier. That okay, oh, in the first 1 month I've done 20%. I will recognize 20%. In the next month I've done 50%. I recognize like that. That one is straightforward. But if you cannot do that, then you based on the cost you recover until the end, then you then recognize whatever is remaining as revenue. But before I move to the one that is satisfied at the point in time, that one is straightforward. That one is not a problem. I quickly need to make mention of something called contract cost. Contract what? Cost. It's just because I mentioned of based on cost incurred to date. That's what we call contract what? Cost. So when you hear contract costs, they don't need to tell you that that's the cost of obtaining the contract and fulfilling the contract. Abi? It's the cost of what? Obtaining the contract and fulfilling the contract.
The amount are paid by both parties.
Yes, that's a contract cost. So the one that relates to the cost of obtaining a contract, meaning the cost of getting the contract. Probably you paid somebody commission to help you get the contract. Okay? So when you paid somebody to help you get a contract, you credit cash. Abi? What do you debit? Really? When you pay somebody like commission, you are just saying something. Yes, now says commission. You credit bank, what do you debit? Where P&L or assets? That's what I want to do. Okay, now, see, if you are sure that you recover that cost, that you get that contract, you capitalize it. You recognize it as an asset. You capitalize it. Contract cost. Cost of obtaining a contract, yes, that you will get. Because you recover your costs. There will be a future economic benefit. That is an asset. Okay, it's just so, but if it's a cost that you incur, whether or not you get the contract, those one you expense. Like probably maybe you have to get a form and you are paying 20,000, just expense that one. Because whether you get the contract, regardless of whether you get the contract or not, you will pay that one. You expense that one. But the one that you now pay to facilitate somebody to help you push, and you are sure you would get, capitalize that one. So that's cost of obtaining. That's cost of obtaining. So accountants, you need to know this. The second one is cost of fulfilling the contract. So now you have gotten a contract, now you have to then start doing the work. Abi? That's cost of fulfilling a contract. That one is clear. You be capitalizing the cost. Yes, assets. You'll be adding it as what? Like a receivable. Like a what? So some people will call it, if it's a long-term contract, they will call it contract receivable. Okay? Because you are sure that you will recover your costs. So the way we now do it is that as you are now transferring the promised goods and liability to the customer, you know that okay, you are due for money. Abi? Then you can then start amortizing that cost again to P&L. You can start what? Amortizing it to P&L on the basis of the transfer of goods or services. The reality is all of these things I'm saying, I might not really go deep for you. That's the reality. They won't go inside, but your accountants, most of you can be faced with something like this. You should know that the cost of obtaining a contract you capitalize, if you get, if the one that regardless of whether you get or not, you are paying expense. Now, when you now get the contract and you are now spending money, capitalize those money you are spending. Okay? Capitalize it. Yes. Then later, as you are now due for money, so you will now be using that basis to be expensing what you have capitalized to P&L gradually, gradually, gradually like that. Yes, you will use that to reduce the asset. Yes, amortizing it. Okay, I just wanted to go there. Contract costs. Now, still on a final note, is when performance obligation is satisfied at a point in time. At a point in time, that one is very straightforward because you recognize revenue immediately when you have transferred control to the customer. So, at a point in time means that at a particular date, you transfer the goods. So, the key word is that have you transferred control? Because there are instances where you transfer the goods and not transfer control. There are instances like that. So we expect that because you could be having a consignment arrangement. Do you know what a consignment arrangement is? Whereby somebody takes goods to you on consignment. It's just in your place, in your location. You are just a dealer. Okay? It's not like he's selling to you. You are a dealer, he delivers goods to you, then you sell. It's only when you sell that I get money. I cannot treat that kind of good I've transferred to you as sales. It is not revenue. It's a dealership arrangement, it's a consignment arrangement between me and you. So at a point in time, there must be transfer of what? Control. There must be transfer of what? Control. Meaning that I'm expecting money, I'm due for money, I've transferred physical possession, I've transferred legal title, customer has control. Customer has control. I've transferred legal ownership, I'm due for money, I've transferred physical possession. In fact, all the risk and reward attributable to ownership is with the customer. You have transfer control. Then you recognize revenue. Then you recognize revenue. And those are the 5-step model involved in recognition of what? Revenue. On a final note, two things you need to know as accountants is the difference between contract assets and a trade receivables. The difference between, there's no way I can teach you IFRS 15 and not made mention of that. The difference between what? Contract assets and trade receivables.